Hi, folks. This is Sean Hyman from The Logical Investor, and I want to talk to you about the technical analysis or charting side of my analysis. Because remember, I have a three-pronged approach: fundamentals first, and then technical analysis and sentiment next. And so there's advantages to charting, and there's disadvantages to charting. So the advantages to fundamentals are when a stock is gyrating all over the place. If I know that it's very solid, it's a huge company, deep pockets, tons of cash, low debt, etc. I know that it's going to make it through, or at least I know that statistically it's highly, highly likely that it'll make it through whatever volatility it's presently in and on to greater days. But if I don't know how it's doing fundamentally, then I'll always be second guessing myself and worried about every little ripple that happens that's a pullback or potential change in trend. So fundamentals give you the confidence to ride through the ripples and to know what it's going to do in the future. So the fundamentals are great at telling you about what to buy, but they're not as good about telling you when to buy it. Now there are some metrics that do help with that. PE ratios, price to book ratios, and things like that, where you can measure the price relative to the earnings or assets. Does help with that, but it's not near as much of a refined tool as technical analysis is. So while technical analysis is not as good as fundamental analysis in telling you what to buy, it is good once you drill down the assets that are worth buying. Once you look at them on a chart, it is better about telling you when to buy them. Again, nothing is going to tell you how to pick a bottom or a top, so get that out of your head. You almost want that as a saying you repeat over to yourself. We're never going to catch the bottom. We're never going to catch the top. We don't have to win on every single investment in order to be successful overall, etc. But technical analysis will get us in at better points and at better prices than if we had just only had fundamentals alone and we didn't have anything technically on the charts to go off of. So with that said, I'm going to explain the handful of indicators that I routinely use on two different time frames. And again, I just want you to be vaguely familiar with these. You do not have to have these indicators and all that. You don't have to have all this under your belt. That's what I'm here for. So I'm the only one that has to have it all figured out. So breathe a sigh of relief if you don't. That's totally fine. But I want you to know what I'm talking about when I'm talking and going through charts in the future in our service, because I want you to know when I name something. I want you to know what I'm looking at, what I'm talking about, and I want you to know its benefits, its uses. So sometimes people have a hard time discerning whether a trend is up or down or whatever, because there's so many just random moves, it seems like, of up and down. And so moving averages help smooth that out to help you tell the medium-term and longer-term trend direction. So for instance, this is Apple. I just picked a stock that a lot of people would be familiar with. This could be any chart pretty much. So we're not talking about anything Apple specific here, but an astute investor would go, this is a downtrend and this is an uptrend, because their eye would be keen to the lower highs and lower lows and the higher highs and higher lows. But when you're newer to investing, it's sometimes tougher for your eye to pick that up, especially when you don't have this strong, obvious uptrend to deal with, and you're just seeing more of this. And so the medium-term trend is tracked by the 50-day moving average. That's this blue line right here. And it will tell you more of the near to medium-term trend. So you're going to see a lot more of the ebbs and flows picked up in this moving average. That's going to tell you what the trend is in the near term, weeks to months at best. So in the first few months, so more nearer term or medium term. And so here you can tell that it's short term to medium term down, but here's short term to medium term up, down, up, etc. Then you've got the long term trend. The long term trend takes into account the bigger picture and changes directions a whole lot less often and it's really smooths out this information a lot. And you can see it was overall over the long-term downtrending here. And then when the price started moving above the long-term moving average and the moving average turned up, and also it helps that there was a what's called a golden cross, which is the crossing above with the 50-day moving average crossing above the 200-day moving average. That's a bullish signal. When they both tend to head higher, that's bullish. But just if you're looking at the 200-day moving average along, here it's trending lower, and then the price starts to move and hold above that moving average, and then the moving average starts to pick up. And so this is when you know that it's starting in a uptrend when the price is above the moving average and the moving average is setting higher. When the price is spending most of its time below the moving average and the moving average is heading lower, you're in a downtrend. Now, again, there will be times where these prices overshoot these averages just a little bit. So I'm not talking about that, just the general direction of them. So that's the purpose of moving averages. They help smooth out the gyrations in the medium and long term and help give you a more definitive direction. So there's a whole lot of technicalities I could get into in the math of all that and how they're calculated and all that kind of stuff. And if that's something that interests you, you can go to places like investopedia.com, and you can just Google moving averages and find out more about how they're formulated and all this kind of stuff. But I think that really is too much to get into, and I really don't think you ever need to know all the nuts and bolts behind it. Now, I know some of you will want to know that, so that's why I offered it up, but many of you will not. For instance, let me give you a different example. Many of you just, you know that you want a car and you want transportation and you want something to get you from point A to point B. And as long as you can get in the car, turn the key, put it in drive, and get to where you're going, then you're fine. You don't have to know how the gasoline and air mixture is, or how all the fuel and firing happens in all the cylinders, and how that communicates and works in conjunction with the transmission and the differential and all that. You could care less. You just want to know that the car drives, that you know how to drive the car and how to get it from point A to point B, and you don't need to understand everything about the engine and the drivetrain in order to be able to function and drive a car successfully. And that's the way it is with these indicators that I'm going to teach you about. I'm just teaching you how to drive, how to use them. I'm not telling you, how many cylinders are in the engine and how that fires off and all that. So I will look on the daily chart using these moving averages, going back at least 1 year in time, sometimes 2. Right now we're on a 2-year chart because I usually want to pick up and see a major low that happened, a definitive low on the chart to know when we change trends. And then on the weekly chart, I will usually go with a 10-year time frame because I want that 30,000-foot view. I want to see what this asset's been doing, the stock has been doing over a long period of time. And by the way, there's other advantages you can pick up off of moving averages as well, and especially as it relates to their weekly chart. Now this works on daily charts as well, but it's really more important on the weekly chart. When the price of the stock, whatever the stock is, like in this case, again, it's Apple, but it could be any stock. When the price of the stock gets way away from especially the 200-week moving average, because remember, we're on the weekly chart now, so it's a 200-week moving average rather than a 200-day moving average on the daily chart. This tells the really long-term trend direction. And when the price gets way away from that moving average historically, like when you look back over time and see how far it tends to get away from the moving average, when that happens, you know that the risks are starting to become very high. You know that investors are starting to become overly bullish on an asset, and they're likely overpricing that asset at the moment. And that there's going to usually be a huge reset that brings this price back down closer to that long-term moving average. Now, it can take some time. So just know that. Like this started getting away from the moving averages, back here in March or April of 2012, and it went a little further into the summer of that year before it actually turned around. But then it has this, this pullback and coming into early 2013 that pulls it back. But yet you could tell that the big pullback was coming because it gave you a heads up. This had gotten way ahead of itself. And then when it pulls back closer to its rising long-term moving average, it becomes, lesser of a risk. And when it has this fall off, like from here, it went from 91 to 51. Well, that's a pretty big deal. And even here, this peak here was 83, almost 84, back to 51. So if you could, know that that kind of a fall is coming when something gets majorly out of whack, not just every little ripple that happens along the way, but when it gets majorly ahead of itself, you can cash out anywhere in this area and let it settle back down and then come back into it. And by the way, when it has this kind of a move from 91 to 51, the news media is just atrocious. They're bashing the stock. So you're not going to have any incentive if you're just listening to the financial media to go back in and buy when it's probably one of the best times to be buying. But buying pullbacks towards that long 200-week moving average can be a very good viable strategy over time. Again, there comes a time where that peters out and will eventually fall through and start a long-term downtrend, but that's when the asset usually finally gets fundamentally way overvalued with a very high price-earnings ratio. And again, I put all that stuff together for you, and I analyze all that stuff. Been doing this stuff for 20-something years, so you never have to figure out how to put the pieces of this pile together. So never put any pressure on yourself to ever have to understand all that. That's what you pay me to do. And so just know that. You'll always just be able to look over my shoulder, and I'll tell you, through the newsletter subscription, what I feel you should buy and when and why, and what I feel you should sell and why, and so forth. But again, the 50-week moving average, picks up what the price trend is over, a few years or so, and this long-term 200-week moving average tends to pick up what the price has been doing over many, many years. In other words, it's the longer-term view, and this is always the medium-term view of the time frame that you're on. Notice that Apple had gotten way ahead of itself historically once again at the time of this filming, and we're starting to see part of the pullback now. And again, it might rally up some more before finally pulling all the way back, like it does sometimes. So sometimes it just kind of it's like an upside down V, peaks and then heads straight there. And then sometimes it bobs around at a high level and then eventually makes its way back down there. But the risks to Apple shareholders is much higher in the near to medium term. And we know that because the price is so far away from the moving average. And this works on to other assets to the downside as well. They tend to return to their major moving average as long as they're fundamentally strong enough to make the turn, and that's where fundamentals come in and help us. So that's moving averages. Now, I want to talk about the RSI, the Relative Strength Index, and normally I use the traditional settings on these indicators, but on the RSI, instead of a traditional 14 period, I use a 6 period. It just responds a little faster. Gives you signals a little quicker, and they're more distinct. That's the easy way to put that. So the way the RSI works is you can see that this indicator goes below 30, this 30 line that stretches across here, and it changes color into the red, shows you that it's oversold is the terminology there. And then you can tell when it goes above 70, this line here, it changes color and it becomes to green, and it becomes overbought. And so the way that you use this indicator is with the direction of the trend in mind. So the trend direction always matters first and foremost. So when the trend is up, which is shown by these moving averages, then you want to buy the pullbacks in the uptrend, and those choice opportunities are going to be when the RSI is in oversold territory and getting ready to head out of it, yet the price of the asset's in an uptrend. So here's an example. Buying in here was a good time. Here's another example. So buying in here was a good time. And right here was a good example of another pop-up. Now remember, the further the price gets away from the major moving average, even if you're getting buy signals here, the risk is high for an ultimate retracement. So there comes a time where you may not, the bar of risk goes higher the further this price gets away from that moving average, the 200-day moving average on this daily chart, and you want to be aware of that and factor that in as well. And then once in a downtrend, when it has the overbought area above 70, is a good time to be taking profits, or for traders, and again, we're not traders, we're investors, that's where they would be coming in and shorting the stock. Now again, shorting stocks is very risky. It's not something that I encourage you to do or anything like that, but the sell signals that happen in a downtrend are very powerful. So remember, the moving averages are pointing down, and so here's the sell signal, and it's in conjunction with this peak here. Here's another above 70 area, which would be the area right here. And again, that's another area. So here's another area like that. And again, it can start in oversold and go up a little more before it actually turns down. Again, none of this stuff is top catching or bottom catching, but it tells you when where statistically things are likely to go next. And so when it's overbought like this in a downtrend, the statistical likelihood is that there will be another downturn. And sure enough, there it is. And here's one more, etc. So that's what the RSI does. And there's other things that it'll do that we'll talk more about as things go along, such as divergences and things of that sort. And again, we'll talk more about that in the future. But basically, that's where when the indicator does the opposite of what the price is doing. So here you had a high, and then you had a higher high happen. But here you had a higher high and then a lower high happen. So this slanted downward while this slanted upward. So that tells you that the upward momentum is likely slowing, and that a trend change could likely be around the corner. So there are other things that you can get out of the RSI that I'll be using as well. Another thing that we'll look at is that can be quantified and seen on the charts is volume. And I mainly note extremely large buying spikes and extremely large selling spikes that are way above the average volume. And how do you know what the average volume is just looking at where most of the volume is trading on any asset at the time. So where there's tons of days where it hits a common area, that's about average. So these spike ups that are in particular 2 to 3 times what's average are worth noting. And you usually want to be doing, particularly on sells, the opposite of what most people are doing, because they're in fear-based panic mode. So here they're selling in mass, and we know that, and we know this is an emotionally charged moment because they're selling far more on this day than they do on an average day. And they were selling here, and it was the worst thing to do. I mean, they were selling at 88 to 90, and it went to 119 fairly soon thereafter. Here's another period where they're selling, particularly here, they're selling in the 89s and 90s, and it got to 109s just very shortly thereafter, the next 60 days or so. Here's another time when they're selling in the 87s, 88s, and it goes to 99 and 108 not too long after that. So those are some things that I look at where I'm looking at extreme negative sentiment, because when people are throwing in the towel, and that's what those are, throwing in the towel moments, they're disgusted, they're in panic mode, they're emotional. It's a way that we can really measure and quantify emotion and how emotional they are. And so if I know something is a very strong asset and they're doing a ton of unusual selling, it's something worth taking note of. And I can check other things like the PE and make sure that it's a big enough market cap company with deep enough pockets, deep enough cash on their books, and low enough debt, etc. But if that's the case, then I can. There's times where I can nibble away at buying some shares when they're frantically selling in mass like that, because they're usually making emotional decisions, which are usually very, very wrong. Then the other thing that we look at is the MACD. And the MACD, again, stands for Moving Average Convergence Divergence. Sounds complicated, but it's really simple. It just helps tell you the trend of the the stock. And so in the uptrend, you want to look more for the buy signals, which are when the lines cross and head higher. So here's a buy signal, which corresponded with this here. Here's another buy signal which corresponded with this here, etc. And then you also look for divergences there. So notice this went up higher from one high to a higher high. This went from a high to a lower high. So that's divergence, another warning sign. When the price starts to pop back below the zero line, which is right here, that can be a warning sign as well that things could be weakening. So there's several things that you can use the MACD for. Again, when you're in a downtrend, you're looking for the sell signals as places to potentially exit. So it's just another buy and sell tool to help you tell when things are about to, turn one way or the other. So that's what you use the RSI and the MACD for. And again, I look at those on both the long-term and the more medium-term charts. So the weekly charts are the long-term bigger picture. People say, oh, you can't use technical analysis in investing. I definitely disagree with that. I use it all the time in investing. Just a matter of the time frames that you look on. When you're looking on daily and weekly charts, that's technical analysis for the investor. When you're looking at very short-term charts where people are trying to trade something within minutes or seconds or within a day or something like that, of course, that's a trader, and they fundamentals of a company aren't going to change within one day, typically. So they're going to have to almost exclusively go off of technical analysis, and they won't value fundamentals at all. So, but technical analysis is not just a trading tool; it is an investing tool as well. And I use the same thing. I look for extreme sentiment on the big picture. I look for divergences, on the big picture that happen, because that gives you a heads up that this turn lower is likely to happen. There's even I look for major sell signals that happen, as well. I look for when things get extremely overbought or oversold in taking the direction of the trend in mind. So these are the bigger moves, the bigger picture moves, the bigger swings on the weekly chart. And the weekly chart is the first and foremost chart that I look at, because it's kind of the 30,000 foot view, and then I'll drill in closer and look at the daily chart. So the daily chart, if I'm looking on, like this is a 2-year chart, for instance, as can be seen right here. I'm at 2 years, and I'm at stockcharts.com. Now I'm on a pay chart, so that means that I get to look further back in time, and there's other advantages you have with the pay charts than the free charts, but they do have free charts that go back several years in time. So this is a 2-year chart that I'm looking on the daily chart, so I can kind of go back a couple of years here, and I know that this is the equivalent of what I saw on the daily chart the last couple of years here. I kind of zoomed in on that area by looking at the daily 2-year chart. So the weekly chart, let me just go with something really shorter term here so you can see candles more distinctly. The weekly chart, this is weekly 1-year chart. Each candle equals 1 week's worth of time. So this is 1 week, this is another week, this is another week, this is another week, etc. And these candles form patterns, and they have their own form of analysis as well. But I don't get real caught up in that. I know a lot of it, but it's a little overwhelming to try to teach you everything that I know all at once. I won't do that. But the red candles mean that it's going down, for the week, and the white candles mean that's going up for the week, etc. And so that's what those look like on a daily chart. And let me go, something that's more zoomed in that you can see more easily. So this is just looking at 3 months worth of data on a daily chart. Same thing. The white candles are up, the red candles are down, but each candle represents 1 day's of activity. So this was a heck of a move for Apple on this 1 day. And there's some days where you get very little activity on it, and it's a day like this. These little plus signs, which are called dojis, they're just indecisive days. So anyway, again, you don't have to know all the mechanics of all that. I'm just kind of giving you some a little bit of insights there so that you'll know when I talk about candlesticks or what have you. So I think that's it. RSI, MACD, volume, 50 and 200 period moving averages that are on the daily 1 or 2 year chart, or the weekly 10-year chart, are the indicators and time frames that I tend to use. Again, same indicators, same analysis on the weekly chart. It's just this is the bigger picture view. The trends don't change as often. The buy and sell signals don't change as often. So whatever's in motion tends to stay in motion for a bit longer. But sometimes when you get up too close, for instance, like let's just say that I'm looking at a Apple over the last 6 months, and I just see, oh, okay, well, this is trending up. I don't really perceive the risks that are there as to when I go to this weekly chart and I look at it over the last decade, and I see anytime this price gets so far away from this 200-week moving average, it tends to move back towards it. Here we are again. Here it comes back again. Here we are again, and here this long-term moving average is. So the weekly charts can really heighten you to massive risks that are, around the corner in the coming days, weeks, or months, that the person who just looks too near term on their charts simply will not see. So that's one of the benefits of looking at the big picture first and assessing it versus just solely staying fixated on one particular time frame. All right, so that's it. Again, I don't want to overload you. I would encourage you to go back and view this video 2 or 3 times, and over the coming months, I would encourage you to go back and review it again, because you're going to put more and more pieces together as time goes on. But keep in mind, to be successful in this newsletter service, you do not have to know one thing I've said. You don't. You don't have to understand one indicator. You don't have to understand one bit of fundamental data. You don't have to understand any of that. That's what I'm there for. So keep that in mind, because I know sometimes people will tend to get overwhelmed. You don't have to crack the code or figure out how the pieces of the pie fit together. That's my job. That's what I'm paid to do. I'll always let you know what to buy, when to buy it, what to sell, when to sell it, and why. And I'll use a combination of fundamentals, technical, and sentiment to tell you why. But I just want you to understand how some of the parts operate and some of the indicators that I use and why. And again, if you want more full definitions on any of this stuff, RSI, MACD, moving averages, volume, etc., you can go to investopedia.com. So that's investopedia.com. It's one of the best investor definition sites out there. There's other ones out there. So you can always just put in Google, into google.com, you can put in moving averages or moving averages for a formula or definition or something like that, and it will pull that up for you. But I would encourage you not to get too much into the nuts and bolts of it, because you can get overwhelmed and off track. So that's why I keep it simple for you. And that's it. So I wanted you to know a little bit about the charting techniques and indicators that I use. And these will stay the same. I very infrequently change indicators. If I bring on a new one, I'll explain a little bit about it. But these are some of the most tried and true indicators out there. There's literally hundreds of indicators out there these days. But these are some of the ones that I've tested a gazillion of them, and these are the ones that I found to be the most helpful and reliable over time. All right, thanks so much for watching, and God bless. Bye-bye.